What's going on YouTube? In this video, we're going to talk about Netflix, ticker symbol NFLX. Year to date, this company is up 20.6% over the course of 1 year. Company is up 45%. So Netflix reports their earnings tomorrow in the post market. And I wanted to go through their financials today and figure out a fair market value of what Netflix is worth today before their financials come out tomorrow. So that way tomorrow, if financials are better than expected based on the EPS and revenue, then it could warrant potentially a pretty decent buying opportunity on Netflix. But if they're worse, then that kind of gives us somewhat of an idea of where Netflix could be headed tomorrow. So as soon as the release comes out, you can probably hopefully get an understanding of where Netflix could be headed based on their report. Obviously, the report on their financials is not everything. It also depends on what the CEO has to say of the future outlook of the company, especially within the how the economy is treating Netflix in terms of revenue. Netflix financials here. We've got our revenue, gross profit, and net income starting to flatline across the board here. Revenues are still ever so slightly growing. Gross profit looks to be pretty flat. Net income we can see over here is ever so slightly declining. Uh, Obviously not ideal there, but sometimes you'll have that and then you'll just resume higher. So our gross margins at the company sitting at 38.8%, pretty good compared to where it has been. Obviously, it's not the best, but still sitting at a pretty good gross margin. Net margins, same things, not the best it's ever been, but still sitting at about 13% net margin as of today. Revenue and gross profit year-over-year change. Obviously, this company has seen somewhat of a ceiling. Looks like it's going to be a slow grower going forward based on revenues and gross profit because of the subscriber count. It seems like subscribers have kind of reached somewhat of a peak, and it appears as though Netflix is only going to be growing at 4, 5, maybe 10% if it's lucky. Return on invested capital sitting 12.5%, pretty good. I'd like to see it a little higher, but that's still a pretty solid return on invested capital for this company. Cash and short-term debt, they basically have the exact same amount of cash and short-term debt. A little bit more debt than short-term, or a little bit more short-term debt than cash currently. Cash to total liabilities, though, they got a boatload of liabilities, 28 billion in liabilities and 8.5 billion in cash. Net income to free cash flow, basically flat between the two of them currently. We'll go over cash flows on the most recent 10Q as well, just to kind of understand a little bit more how their cash flows are set up. And we can see their free cash flow had been declining quite a bit, and ever since 2020, it's reversed and gone higher, which is always awesome. Share count dilution, they are diluting shareholders, but not at a high rate. Hopefully that stops and starts going down. Capital expenditures, pretty good for CapEx, sitting at negative 300 or negative 360 million. And a company that's doing, I don't know, 32 billion in revenue. That's pretty solid CapEx right there. So one thing we wanted to do is just share the cash flows of Netflix, because we've noticed that potentially we'd have to look back further and see how these cash flows were calculated in the prior years to understand if there were actually positive free cash flow, but they didn't amortize their current or their amortization of content assets. So you can see here, those are some massive expenses in their cash flows here. And as of lately, they've basically amortized most of, if not more than, as they did more than here, than their additions to content assets. So when they do that, it makes their cash flows almost equal to what their net income is. And over here, obviously, it's more than their net income because of all these other changes within their cash flows, which are relatively nominal, but they do add up to much more than what their net income was. But we can see back here last year that additional additions to content assets was 4.7 billion, and they only wrote off 3.3. So there's 1.5 billion there, roughly 1.4 billion. And you can see that's basically all of their net income. So it gave them basically a zero on free cash flow after they get rid of property or do CapEx. So they basically made no free cash flow in the last 3 months this time last year. So kind of get an understanding of that, how big of a deal that is in their free cash flows. And if they weren't amortizing most of their additions to content, then maybe that could have impacted their free cash flows. And if you could have, amortized it yourself and said, okay, well, if they just amortize all of their content assets, then their free cash flow is basically their net income, roughly. So, and assuming that's how it was, obviously we'd have to look back at that and understand that better. But, that could tell you that these free cash flows here might have been a lot better. It could have been equal to roughly their net income if that's how they were set up. So, but just a food for thought on that. Apple, Amazon, and Disney, and we should probably do Warner Bros. As well, WBD. So we'll have four comps to go with here. Apple's probably the least comparable. Warner Brothers and Disney is probably more comparable than the other two there. But I feel like the other two also support streaming services. All right, so we got our market cap here. Amazon, Apple, kind of hard to read that map there because of those two on there. So we'll probably just jump over to here. On the growth rate, we can see where Netflix is growing. I don't know if I believe that growth rate that much, but EPS 21%, revenue at 10%. That seems a bit high, but I guess we'll see. Warner Bros. Though, looking like it's got about 8% revenue, and Disney sitting at about 6% revenue. Obviously, Disney has more than just streaming services. It's obviously got its parks too, so that could be either pulling back the streaming service revenue expectations or not. Gross margin, we've got Netflix doing pretty good gross margin. I would say I would compare it to both these two companies here. This is a little tough to compare. I think Warner Bros. Is probably going to be the best comparable in the bunch here overall in these profit margins. This might not be a very good comp spreadsheet here because these other three companies do more than just streaming services. So I think what we'll do is we'll just kind of look at Warner Bros. To Netflix really is I would consider the main focus here. But we can see right off the bat anyway, Netflix is still doing very good in operating margin, profit margin, same difference over here. Warner Bros. Can't quite turn a profit yet, or at least right now. So we got Netflix doing 4.2 billion, Warner Bros. Doing 3 billion in free cash flow, return on invested capital. Doing pretty good over there on Netflix. We already know that. PE on Netflix is kind of rich, sitting at a 38 PE, even with a big pullback on it. Obviously, people are willing to pay a little bit more for Netflix for what it is and how it is a very profitable streaming service. Can you believe Disney's trading at a 70 PE? That's insane. Amazon at 104. Over here at the calculators, we got Peter Lynch valuation is giving a price tag on Netflix of $241.35 per share. Multiples comparison, Warner Bros. Is not profitable. And I don't know that these three are very good to comp to Disney or to Netflix because they are involved in other industries as well. They're not just, obviously we are well aware of what Apple and Amazon and all Disney do, and Netflix is basically just your streaming service. So it's kind of this one's tough. I don't think that this is a very good comparable. I think that this should probably just get eliminated from our analysis at the end of the day here on our summary for our price target. So I think I'm going to do that. Manual PE, take our market cap minus cash, add in debt, divided by cash from operations. We get a 38 PE. So that's telling us we're pretty overvalued on Netflix. Price to book, 5-year average 14, currently 6.92. So pretty good compared to its 5-year average. PEG ratio is telling us this company is richly valued. We got a growth rate and EPS of that and a revenue 11%. So yeah, definitely telling us we are very, very overvalued. Graham's valuation gives them a price tag of $482.48. Discounted cash flow. Analysts did not have a free cash flow growth rate, but over the course of these last few years, their free cash flow has exploded to the upside. So I'm willing to give them a 15% growth rate at least. And that gives them a price target of $207.28. Rule 72, EPS, current PE. We have three different sources for EPS growth rate. That averages out to 20, well, 19.9. That goes into 72. 3.6, that goes in 10 years, 2.76 times. So we get to double our EPS 2 times and then 0.76 times. So I gave them a future EPS of 70. Fair value, $696.54. So at our summary for Netflix, currently trading at $355.72. we get a fair market value with our multiples included in here of $453.42. 30% margin of safety, $317.40. Annual price target, $422. So let's eliminate the multiples once. Let's see what that gives us. So that gives us $406.91 for fair market value. Purchase price, 30%. Or sorry, 30% margin of safety, $285 per share. So that puts us below analyst price target. I think that is way more correct because I feel like those multiples that we had to compare to weren't very accurate for this company because they're involved in so many other things. So that's my price target on Netflix is $407 per share. Over to the stock chart on Netflix. So we can see Netflix was down at $162 per share once upon a time. And since then, never looked back and has ripped all the way up to almost $500 per share. But since it hit that, it's pulled back almost all the way down to 100 or $350, so about $150 down from its all-time recent highs there. And since then, pulled back to a potential support zone, pulled through this this trend line. So this could mark as though it depends on what happens tomorrow. This candle will determine whether or not this is going to be a full breakthrough of this trend line or if it's going to continue lower. And if it does continue lower, you could look to probably pick up shares, maybe about $285 per share. I think it's really going to depend on what the financials, like what the revenue and what the EPS come out at. If this thing pulls back to 285, I mean, honestly, if it pulls back to 285, it's probably coming down to 260. That to me was another support range that I saw, long-term support range. So if it pulls through this and breaks this, it's probably coming down to 260. And then if it holds this, it's probably got a good chance of at least retesting $500 per share. So a little bit of a tricky one on this one. I don't know if I would buy this ahead of earnings, but definitely once earnings come out and you'll see the revenue and EPS side of things, you might be able to jump on board and see if you kind of get an idea today of where this is valued at with what we just went over. And then that might help tomorrow for if you play earnings or not, or if you want to maybe buy it ahead of earnings, maybe pick up a share or two and see what happens. Maybe you can make good money. Otherwise, you can just DCA down if you wanted to, if that's in your plan, if that's something you're willing to do and stomach. If you pick up 2 shares and it ends up pulling back basically $100, but then you could DCA in and then your dollar cost average would be about $300-ish per share. But then again, if you do that, you'd have to wait until it hits 260, 250, then add, and then wait for it to come back higher. So that's something that you got have a lot of patience for and believe in this company. Now, I don't think Netflix is going anywhere, but it doesn't mean it can't continue lower and trade at like $250 per share if financials don't prove themselves. But that is it for Netflix. A simplified approach is to decide if the company possesses characteristics of a great business, such as a moat, healthy financials, honest management, sustainable growth, and an edge against competitors, etc. Once it's established that the company is, exceptional, the value should tell the investor how much to pay for it. So I mean, that's kind of what we try to do over here is, we go through the financials and it's kind of up to you to understand and determine if you think that this company has a moat. If you think that financials are healthy, which usually it's a pretty obvious thing to see, if there's honest management and if there's sustainable growth in the company and if there's an edge against competitors, which I think Netflix has a great edge against competitors. I think Netflix is a great business and a very profitable one. But that is it for Netflix. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.